Hey guys, how's everyone doing? This is Nick from forexnoobs.com with the daily analysis. Today is Tuesday, the 10th of March 2020. Time is 13:01 here in the UK. Now, there's a lot to talk about today. Not sure how much of it is going to be good news for you guys, but there's a lot to talk about. First things first, if you have looked at the charts, which I'm sure most of you have, you'll notice that there were some pretty crazy moves yesterday. Pretty big gaps, pretty crazy moves. Now, most of you probably know why this has happened, but in case you don't, let me break it down for you. It's all due to the coronavirus, really. The coronavirus is causing a lot of issues right now. So, crude oil just tanked over the weekend. You could see that on Friday, last Friday, it dropped down a fair bit. Then when it opened on Monday, whoosh, that is a big drop. This is just WTI. This is, but it's a good representation of what's happening. So it is somewhat recovering today, but the demand for oil has really fizzled out due to the coronavirus. So, and there's some big geopolitical things going on with OPEC and Russia, blah blah blah. I don't fully understand it. I'm not gonna get into it in too much detail. But the point is, prices are being slashed on oil right now, and it's having a knock-on effect to the rest of, well, to all markets. Not to mention, there's just a lot of things going on in other markets like the futures market, etc. It's just getting pretty crazy due to the coronavirus. And there's just a lot of fear right now also. People are talking about corona triggering a recession. Because we've been long overdue a recession anyway. The point is, there's just lots of fear, uncertainty in the market. Oil prices are going crazy, which is having an effect on a lot of Forex pairs. So going back to Forex, we can see the effect that it's had, on a lot of pairs, New Zealand being one of the bigger impacts. Then you got the impact on CAD with that huge gap over the weekend. Where's USD CAD? Do I have it up here? Am I being blind? Yes, I am. A huge gap over the weekend. This is a gap unlike any I've seen in recent years. I think you'd have to go back to 2008 to find a gap of this size. That gap is bigger than, I would say, 90% of the candles we've had in the past year. The gap alone is bigger than the 90% of the daily candles we've seen in the last year. It might be a bit of an exaggeration, but it's bigger than a lot of them. So what does this all boil down to, guys? It all boils down to, this is not the time to be trading the daily charts. It's really that simple. Now, a lot of people don't want to hear that because they're saying, oh, we're traders, or especially if you're new to the market, or we're just learning to trade and now this. But in my opinion, this is a really good lesson to learn early on, because one of the most valuable skills a trader has is knowing when to sit on their hands and not trade, right? And, I'm not saying that I'm not trading at all. I'll tell you what I'm going to be trading, so hold on for that. I'll tell you what I'm going to be trading. I'm going to tell you the measures I'm putting in place to protect myself. But what I'm not going to be doing is trading the daily charts, and I'll explain why, and I'll explain my thinking in this analysis session. But getting back to my point, one of the most valuable skills for a trader to have is to know when not to trade. Because ultimately, the main goal of a trader is to protect their capital. Not to make money, to protect the money you have. That's your number one goal. Making money is like, down the list. But your number one goal is to not lose money, to protect your capital. Now, this isn't just something I'm making up. If you look at all the best traders on the planet, the most experienced traders, they'll all tell you the same thing. Go look up quotes from the most experienced traders. Paul Tudor Jones, for example, being one of them that I can bring to mind right away. It's all about protecting your capital, protecting the money that you already have. So that's because that's the main goal. One of the most important skills, if not arguably the most important skill, is knowing when to stay out. Because if you know when to stay out of the market, you're protecting your capital. You're achieving your number one goal of not losing money. So this is most certainly a time to stay out of the market. Now, a lot of people are going to argue, yeah, you can make money in a market like this. For sure you can. But in my opinion, retail traders like us can't make money in a market like this. If you're a bank, if you're a hedge fund, if you're a managed fund, if you're someone who has access to tens of thousands, hundreds of thousands, millions of dollars worth of data that you buy from companies like Bloomberg, Reuters, and all the big companies that feed you this financial data, then yeah, you can make money in a market like this, of course. If you're a retail trader that trades using charts and maybe using fundamental analysis that you get off websites, it's going to be that you have to piece together yourself. You're going to struggle to trade safely in a market like this. Now, there are a few things that we can do in order to potentially trade through a market like this without losing a lot, and with possibly even making profit. That's what I'm going to be trying to do over the coming weeks. So we're going to have a bit of a change to how this analysis works. We need to react to current market conditions, and that's what I'm going to be doing. Current market conditions, for me, require a few changes in how I approach trading. So, number one change is to lower my risk exposure. Basically, what I'm going to do is give you 5 rules that you probably should think about implementing. 5 rules that I'm 100% going to implement. I recommend that you implement them. Number 1 rule is lower risk exposure. We're going to slash it by 50%. So that means if you were normally risking 1% on a trade, risk 0.5%. If you're normally risking 2%, risk 1%. We're going to slash our risk exposure. The benefits of slashing risk exposure is that slippage, which is going to be quite common in the coming weeks, I believe, isn't going to affect us as much as it normally would. If you get slipped, if you're risking 0.5% instead of 1%, and you get slipped, 25% on your stop loss, then these numbers are hard to work with. Let's just go with 1%. If you risk 1% where you would normally risk 2%, and you get slipped 25% of your stop loss. It's so bad to explain this without visuals because it's just me saying random numbers. So look, I'm just going to boil this down to lowering your risk exposure is gonna make it so slippage doesn't really hurt as much. Okay, so I'm going to lower my risk exposure by 50%. That's the minimum that I'm going to lower it by. So any trade I take, I'm risking at least 50% less than I would normally risk. That's rule number 1. Rule number 2 is to lower my time exposure. Now, time exposure is basically the time that you're in a trade. Okay? So the time that you're in a trade. So this is why I'm switching away from the daily charts. Because daily charts require you generally to be in a trade for several days. Now, why is lowering your time exposure important in a market like this? Well, it's quite simple. If you're in a trade for 3 days, you're way more likely to experience some surprise news that's going to cause massive moves and potentially slip you out of a trade with massive losses. So looking at New Zealand USD, for example, well, it's probably going to be a bad example, but it's an okay example. Just have to use our imaginations a little bit. But let's say we're trading the hourly charts. We're in a trade for a few hours. We go long, maybe, or short. Let's say we go short. Let me zoom in. We go short at this resistance area with a target down at this support area. This is just an example. I'm not saying I would have taken this trade. I'm just giving you guys an example. Now, we would have been in this trade 1, 2, 3, 4, 5, 6, 7 hours before hitting target, maybe 6 hours. Great. So the window of time that we're in this trade is 6 to 7 hours, right? That means our time exposure is quite low. Now, if we're on the daily chart, we might be in a trade for 3 days. Now, when you're in a trade for 3 days, your time exposure is high. This is 24, no, it's not. This is 40 hours here. So 40 hours, that's less than 2 days, obviously. So with a time exposure of less than 2 days, we've experienced a pretty crazy swing that could have cost us a lot of money here. That could have cost us a lot of money. It could have slipped us, double of what we would normally risk. So we might risk 1%, then we got slipped double. So now we've lost 2% in a single trade because of slippage. You don't want that, because look how fast this happened. This is a 5-minute chart. This was a fast move. So if you lower your time exposure, you lower the chances of being stuck in the market or being in the market during one of these crazy moves. Now, you still could be in the market during one of these crazy moves if the 6 hours that you happen to be in a trade is during this time, and then you will get slipped. But because you've lowered your risk exposure also, and not just your time exposure, the slippage won't hurt as much as it normally would. So, lower time exposure, lower risk exposure. Next is not to hold trades over the weekend. Guys, I cannot stress enough how important it is to not hold trades over the weekend for the foreseeable future. I have traded through markets with these kinds of crazy gaps before. This is not anything new to me. These kinds of crazy gaps, I've experienced them before. And holding over the weekend during these crazy gaps is insanely dangerous. Let me explain why. Imagine you were short on USD CAD and you held over the weekend. So I know this isn't a valid trade, but let's just, for example's sake, say this is your entry. This is your stop loss. This is your target. All right, and that was on Friday. We'll actually move it to Friday. That was on Friday last week. Come Monday, what happened? It gapped all the way up to here. Now, depending on your broker, but most brokers, they're not going to stop you out here. They're going to stop you out up here. That's 75% extra loss. 75% extra loss on this trade. So if you risk 1%, you've lost 1.75% of your account with this gap. Potentially. Now, gaps can get a lot bigger than this. I've seen gaps that are huge. You'd have to go back to like 2008, 2009, and there was times around there. I can't remember the exact years or months, but there's been times back in the past where, oh, you actually don't really see gaps here, do you? At the time, there were gaps. Oh, yeah, you do. I'm not sure how accurate this data is in terms of gaps. But anyway, my point is, I've traded through markets with these gaps, and I've been slipped before on my stop losses due to gaps. It's not something pleasant, not something you want to go through, not something you want to put your account through, not something you want to risk. So do not hold trades over the weekend. That's more important than the first two rules I discussed. Do not hold trades over the weekends. Okay, guys? Do not. You could get massive, massive losses if you do because of gaps. You have no control over, well, potentially, you have no control over your trade on the weekend. All right? Does that make sense to everyone? Does anyone have any questions about that? That was rule number 3. Rule number 4, don't hold trades overnight without alarms. So in a market like this, we want to make very, very good use of our alarms. And generally speaking, we don't even want to be trading unless we are viewing the charts. But if you're not able to look at the charts the whole time you're trading, then you want to make very good use of alarms. So I'm going to be placing alarms. Let's stick with this example here of a trade. I'm going to be placing alarms a fair way before my stop loss is hit, fair way before my target is hit. So let's just delete these old alarms because they're not. Normally I religiously delete these, but I've been a bit lazy. So let's imagine the trade is here. I'm going to set an alarm here, for example. I'm going to set an alarm here, for example. This is just because I want to be alerted when price starts moving against me. Because I want to try exit early a lot of times. And if a trade's just not going in my favor, I'm probably not going to hold on to it for long. Alarms just serve to alert you when price is moving against you or in your direction. And they're going to be important in the coming week. So make sure you make good use of alarms, set your alarms, especially if you're going to be holding trades overnight. I can't remember the next rule. Oh yeah, I can remember. This is rule number 5. I'm going to set a 24-hour cooldown from trading after big spikes to allow the market to recover. Minimum of 24-hour cooldown. What does that mean? That means after crazy moves like this one here, like we had on Monday, like this one here, which is one of the crazier ones, I'm going to let the market kind of return to some degree of normal. So I'm going to set a cooldown of 24 hours. So after moves like this, I won't be trading for 24 hours, which essentially means I won't be trading for pretty much all of today. I'm going to start trading again tomorrow. So those are my 5 rules that I'm going to be putting in place. Now, beyond those rules, how am I going to be trading? Well, like I said, I'm going to lower my time exposure, so I'm not going to be trading the larger time frames. I'm going to drop right down to the 1 hour, the 4 hour being the highest time frame, but I highly doubt I'm going to take any 4 hour chart trades, guys. I'm going to try to focus on the 1 hour, the 30 minute, and the 15 minute. That might not be ideal for everyone, but, and if it's not, what I suggest is for this week at least, to just not trade. Just don't trade this week. Wait till next week. The market might calm down next week, and we can trade the daily charts again. But for the rest of this week, I'm not trading the daily charts. I'm going to stick to the 1 hour, the 30 minute, the 15 minute. it's just what we need to do, or what I feel I need to do in order to trade a little bit safely, at least, throughout this period. So I'm not going to be trading today, therefore I'm not really going to do much analysis today, or any analysis. I am going to be trading tomorrow, unless we get some crazy moves today that require me to implement my cooldown rule for another 24 hours. So unless we get some crazy moves today, I'm going to be trading tomorrow. I'm going to be looking at the 15, 30 minute and the 1 hour, which means instead of doing these analysis sessions like we do normally, I'll still probably do the analysis just to keep you guys updated on my on how I'm trading through this coronavirus thing. I'll still be doing the webinars each day, but my actual analysis is most likely going to be posted to the forum and to the chat room, where I'll be trading the lower time frames. I just do not feel that these kinds of analysis sessions are that great for sharing 1 hour chart trades, because by the time the analysis is done and it gets posted to YouTube, a lot of the stuff has already moved and the trades really aren't happening anymore. Now, in tomorrow's analysis session, what I'm going to be doing is giving you guys an update on the Corona stuff. We're going to be looking at the markets, seeing how things are moving, and I'll let you know if I'm going to be trading. And we will take a look at some potential 1 hour chart setups. But keep in mind that if you do not watch the analysis quickly enough after it's posted to YouTube, it's very, very possible that the potential trades that I spot on the 1 hour chart just will not be valid anymore, because they'll be, already triggered and already moved. Marie, that's a very good question. Trailing stops are not something that I can easily implement into my larger time frame strategy, because there's often a lot of retracing when I'm in a trade. So a trailing stop is just going to stop me out way too early, unless it's very wide. And then if it's very wide, then I may as well not have it. So on my larger time frame strategy, it's quite hard to implement trailing stops. On my lower time frame approach, I could implement trailing stops, but I don't use them currently. And trying to just throw them in changes up my risk management rules. And risk management is not something you want to be messing with on the fly. So I probably won't be using trailing stops, personally. Now, do I recommend it for you and for others? If you feel comfortable changing your risk management rules on the fly, or if you already have plans, not plans, if your risk management rules already allow for stop loss, for trailing stop loss usage, then sure, this would be a great time to use them. But I can't just say, I'm going to use trailing stops and just throw them in all of a sudden, because I have no actual numbers that I can use in order to place effective trailing stops. It would just be a complete guessing game, and that's not something you really want to do in trading. Does that make sense? And are there any other questions, guys? There's been times in the past, and it's been a long time since I've done something like this, but there's been times in the past where I've done something like this. I've said, look, guys, shouldn't be in the market right now. You should change your approach to trading. And people are just like, I'm going to ignore him. And that's fair enough. It's your choice whether to ignore me or not. But take it from someone who's been trading for, I don't even know how long I've been trading, 2003. So we're going on to 17 years now. I've been through these kinds of periods before. In the financial crisis of 2008, that was the main one, but there were a few other periods throughout there that I can't remember the exact dates of, but there was a period of several months, this is going back 10, maybe even 12 years, where China was talking about diversifying its US currency holdings, and things got crazy around those periods. There's been a lot of times, well, not a lot, but there's been several times like this, not related to pandemics, but related to other massive economic events that I've traded through. And I've seen people who just ignore it, and it's almost always cost them. This is not something you want to ignore, guys. This is having a very real and very dangerous market impact. And you really need to alter your trading in order to trade safely through these conditions. I just want to make that as clear as possible. If you ignore the impact the coronavirus is having on the market, it's going to be very perilous for your trading account, for your capital. And you're going to be breaking the number one rule that every trader should have, that every experienced trader will tell you, which is to protect your capital. So I believe I'll end this webinar with how I started it. The most valuable skill a trader can have is knowing when not to trade. And this is certainly a time where you don't want to trade. At least not the daily charts, larger time frames. You can still technically trade, but you have to take a lot of precautions, which are laid out in the 5 rules. So the most valuable skill a trader can have is to know when not to trade. And this is a time where, at least for today, I won't be trading. I'll ask one more time if there's any questions. If there's no questions, we're going to wrap this one up. I find this whole coronavirus thing kind of, well, funny is the wrong word. But it started out with people saying, oh, it's just the flu. It's no worse than the flu. And then it spread to Europe. Then it spread to America. Now we got Italy, who's basically shut down their entire country. I got a lot of family in Italy, so that's pretty worrying for me. Shut down their entire country in reaction to the coronavirus. We got a lot of European countries dragging their feet. We got some European countries who are massively preparing for this thing to hit them hard. Like the UK is preparing quite well, from what I've been told by people I know who work in hospitals, etc. But then you got, other countries which aren't doing anything. But I'm honestly not that afraid of the coronavirus on a personal level because I'm healthy. I'm relatively young. So it's unlikely that it would affect me. I'm a little worried for family members who are older. But what worries me the most about this is the economic impact it's already having and that it's going to continue to have. Now, this is no longer about trading. This is where I'm just talking here while I'm waiting for potential questions. So you don't have to stick around for this. But the economic impact is scary to think about because this is going to affect the economy on pretty much all levels. From mom and pop shops to massive chains, travel agencies, what do they call airplane companies, cruise ships are going to suffer. They're already starting to suffer. So the travel industry is going to get absolutely butchered. The entertainment industry is going to suffer massive losses. The dining industry, so food, etc., restaurants, massive losses. There's already restaurants are already just emptying out because no one wants to be in a restaurant during this thing. And it's potentially going to lead to a recession. Very, very likely. As a trader, recessions can be very, very profitable. Still to this day, the most profitable time that I ever traded through was the 2008 financial crisis. That year was just the year that made me, really. It's the year that grew my account the most, and it was just amazing for me. Now, I personally am not looking forward to a recession because while it would probably be good for me and my trading, it would suck for 95% of the population. So my friends would suffer, my family would suffer. But for me personally, a recession could be very good money-wise. So as traders, it does, if we do fall into a recession because of this, which is getting more and more probable as every day passes, it could be very, very profitable for us. It would require a shift in the way we trade, most likely, but I would see it being very profitable. But I would happily just have things stay the way they are right now to avoid all the pain that a recession would bring to everyone else, even though for us personally, it might be a good thing. I'm happy to not make the extra money I would make in a recession, to have things just stay the way they are for everyone else. Anyway, that's my take on it. A lot of people call this recession talk fear-mongering, but you just have to look at the numbers to see where it's all headed. So I think we're going to see some turbulence this week, possibly some turbulence next week, but as always, things in the markets do kind of settle when this becomes a new normal, and then the trading can resume. Recession is still a long way off. Recession requires consecutive downturn for several quarters. I think 2 quarters is the minimum requirement. I don't know. I'm not an expert on what the definition of recession is in terms of how long the downturn needs to last. But we're still if a recession is hitting, we're still a while away from it being official. But for now, I don't think this crazy turbulence is going to last. The market normally just kind of returns to normal during periods like this, and it becomes a new normal. And then you're still going to see spikes like this. Probably not this big. You're still going to see spikes like this. but 90% of the time in between those spikes is going to be kind of normal trading conditions. Yeah, I think the recovery is probably going to be short-lived. But look, I'm not an expert on the stock market. Like, this is not something that I'm an expert in, so you shouldn't really take my word for it. We have seen a recovery, and that's great, but I just it's a pretty normal pattern, isn't it? Where stuff has a violent drop, recovery, followed by a further drop. So it would not surprise me if this continues to fall. And this corona thing, like, it's probably only going to get worse. There's no way to contain it. It's going to spread. It's just right now countries are trying to, a lot of countries are trying to reduce panic. And at some point, the panic is probably going to set in, and the effect on the markets is going to be worse and worse. So we'll just have to see how it goes. I think the recovery is probably short-lived, but hey, if it isn't, that's great. That's better. Fingers crossed that it isn't short-lived. Fingers crossed that we get a recovery. But yeah, guys, it doesn't look like there's any other questions. Oh, sorry, I didn't see that, Janine. You worried about your family in the hotel business? Yeah, the hotel business is going to be hit. Everything really. Well, not everything, but let's say 90% of businesses are going to take a massive hit. So, yeah. So yeah, guys, to summarize, the precautions I'm going to take, I've already laid them out, but just a quick summary: lower risk exposure, lower time exposure, don't hold trades over the weekend, don't hold overnight without alarms, and set a cool down after massive spikes to let the market normalize again before you start entering trades. Those are the 5 things I'm going to implement. On top of that, my trading strategy is going to change slightly, where I'm only going to be trading 1-hour charts or lower. I might look at the 4-hour charts, but it's highly unlikely. 1-hour charts or lower. Most of my trades are going to be posted to the chat room and the forum. It's going to be hard to do analysis for 1-hour charts or lower in these daily analysis sessions, but I'm going to give it an attempt and see how it all plays out. So tomorrow I'll be trading again. Today I am not trading. Tomorrow I'll be trading the 1-hour charts and lower. That's it, guys. Stay safe. Stay indoors if you can. And definitely do not ignore the impact on the market, because it's going to suck for you big time if you do. Because if you were on the wrong end of this move, you could have lost a lot. So number 1 rule, protect your capital, guys. Thanks, and I'll see you guys later.